Mickey Dickey here, and I'm just giving you my 2 cents worth on what's going on with J.P. Morgan taking over of First Republic. A couple things. The bank was seized by the FDIC and then taken over by J.P. Morgan. Jamie's worked out with the FDIC with some guarantees and some backing on all this stuff that it is in the real scheme of things. A couple things I want to point out here. And it is of note that Jamie is coming out and making some of these comments that this part of the crisis is over and that it's nothing like 2008, 2009. And I want to point out what he's really trying to get at here. And if you take a look at the bank failures, and this is from FDIC here, guys, okay? When you look at what happened in 08, 09, 2010, 2011, look at the years leading up to this crisis. Now, we're always going to have bank failures, just like we always have businesses that fail. So keep that in mind. Some banks are run right, some aren't. So let's not think that all banks are going to be run perfectly. Because again, you look at 2001 through 2007, and we had what? 15, maybe 25 banks fail in 6-7 years. Then all of a sudden you've got a ton of them that collapse during this time frame. So again, this kind of lasted longer than we expected as well. And then you look at the last 5-6 years, and there's hardly any that have failed. And again, we have to define failure. Some of these banks that they didn't necessarily fail, they were maybe bought out by another bank before they failed too. So anyway, so it's not that it doesn't happen. The key here is the size of these banks, but more importantly, how these banks were set up. So yes, it happens. And I mean, there's plenty of different statements out here. Here's one from CNBC where J.P. Morgan takes over First Republic after biggest bank failures since '08. Okay, we got it. And here's Reuters. And again, it's not like we couldn't see this coming. Something was going to happen here. So what does it mean? Here's what it means in the scheme of things. Absolutely nothing to the average person, because what I want you to focus on here is what Jamie is saying. This is not a systemic problem. This is not a situation where we have a bunch of toxic assets on the books of a bunch of banks. These were a couple of banks that were not set up correctly. When you have too few of your accounts have too much money, it's going to mess up your portfolios. It's just like anybody else, just like a stock portfolio. You don't want all of your eggs in one basket. You don't want to put 90% of your money into a couple of stocks. It's not going to work that way. And these banks were over their skis that way. Now, again, my personal opinion is that some of this stuff was caused by those same people. Okay. So when you start looking at who's at fault, it's easy to sit back and say that the regulator should have caught it and the bank shouldn't have done this. And okay. But what does it mean to you and me? Now, if you owned stock in First Republic, you're out. If you were a bondholder of First Republic, you're out. You're not going to get anything. You're done. If you have $500 in a savings account there, your money's safe. It's just going to get moved over to J.P. Morgan. And again, it may not happen today or tomorrow, but over the next few months, that's what's going to happen. Your money's going to get pushed over to J.P. Morgan, and it'll be part of that. Your money's fine. If you've got $10 million at First Republic, your money's fine. It's not a problem. It's just all part of J.P. Morgan at this point. So the only people that are really going to be negatively affected by this monetarily is if you own actual stock in First Republic and if you're a bondholder. And honestly, I'm okay with that. And I hate to be that way, but if you're a bondholder and you're a stockholder, that's the risk that you take by having stocks and bonds in different companies. So they should be going down. Now, what the bigger question is, what does it mean for the rest of the industry? Again, if you have your money at a local bank, and let's just say it's a small regional bank, or not even regional, maybe even smaller than that, is this going to affect that bank? It shouldn't, because most banks have the vast majority of their money with people that don't have $250,000 that we're just normal people like you and me, just average Joes that have their money in a regular banking account. So unless just all of you guys go together, if you're small, let's say you're a 2-branch bank, and there's some of those out there, unless everybody goes down there and just starts taking all their money out, this shouldn't affect them at all. It shouldn't affect your average regional bank, and it shouldn't affect any of the major banks. And part of it is not just the way they're set up, because like I said, these kind of banks had far too much money from too small of people. Again, if you have 10 people that can pull out $40 billion in a matter of an hour, again, you have too much concentration there. The majority of banks are not that way. So is there a liquidity problem? To some extent. You do have some banks that probably have too many treasury bills at too long a terms at 1%, 1.5%, 2%. But the thing to remember about all this is that those stocks or those companies will be able to divest those treasuries over time. Not all of them run 10 years. Not all of them run 5 years. Not all of them run 7 years. There's going to be some that are on 6 months, 12 months, 2 years. So what will happen is over the next year or two, if the banks have the ability to borrow some money or get some money, assets, what they'll do is they'll convert some of those treasury bills from a 1% treasury bill to a 5% or 4.5% or whatever they can get. And that'll work itself out. Or they'll just wade through this, and as these treasury bills come due over the next 6 months and a year, they'll either redo them into the higher ones or maybe set it aside in liquidity so that they don't have any more problems down the road. Now, part of that's going to help because interest rates have come back down a little bit. They're not as high as they were a couple of months ago. Even with the Fed probably raising another quarter, I don't think you're going to see a major push on interest rates over the next 60, 90 days. Barring that, interest rates over the next year or two will slowly come down, which will help that process out as well. So again, I didn't think it was a big problem in the beginning, and to this extent, I don't think it has become a major problem. Was it a problem? Did it need to be dealt with? Sure. But that's with anything in the world. So when you're looking at these banks and you're looking at what's going on, and I'm looking this more for you on a local basis, there's nothing to be afraid of, in my opinion. I think your money is secure. I think the financial system is secure. Now, does that mean that there isn't going to be another bank that fails? No, I don't want to say that. There might be another bank out there that is too far over its skis. And if it is, I think it'll be dealt with. And maybe Jamie and JP Morgan don't buy it. Maybe it's another company. Maybe it's B of A. Maybe it's, who knows? Because they weren't the only ones bidding on this. My guess is they probably weren't even the highest bidder on this. They just were probably they probably had the best program. And my best is I'm guessing that the Feds looked at this and said, hey, we allow JP to buy this. The market's going to like this better because it's JP. And they're going to feel more comfortable having them own it rather than maybe a smaller one and be concerned that maybe there's more liquidity problems down the road. So it's probably the best answer in the scheme of things, and that's okay. Now, is this the end-all be-all? No. But I do think it puts at least a solid Band-Aid on what's going on, and probably even more so than that. I know Jamie well enough that he's not going to jump into this thing and have it become a problem down the road. He wouldn't be doing this if he thought it was a problem. And he wouldn't be making some of the comments that he is. So overall, I think this is a very positive thing. I wish it had happened maybe a week or two ago. I guess they were trying to see if it could work its way out of it. But the bottom line for anyone that's watching this, looking at it, it should not affect you unless you actually own the bonds and or stockholder. And then you're not going to get your money. But the rest of this, it shouldn't be systemic. It shouldn't be a major problem. It shouldn't be continuing. Even if it happens to get to one more bank, I don't see it. And I'm sure we'll hear about it here in the next 60 days, barring something new. If the Fed continues to raise rates and this becomes a bigger problem and interest rates start ballooning back up, okay, maybe it may become a problem. But I don't see it becoming a problem under the current situation. And again, situations can always change. So keep this in mind when you're looking at this. And again, I'm not suggesting you buy, sell, or do anything as far as stocks, are concerned. It's probably going to be an issue for these banks down the road. It's probably going to be somewhat helpful for Powell. You're probably going to see some more layoffs because as JP merges and takes care of issues with the bank, there's going to be some merger problems. They're going to get rid of some. They're not probably going to need as many tellers. They're probably not going to need as many bank officers. They're not going to probably need to have as many loan officers. There's not going to need to be as many executives. So there's going to be some fallout on this, which is going to be some economies of scale, and there's going to be some unemployment coming out of this. So again, as far as the Fed is concerned, it's probably a net positive because of that. And it's probably going to end up being a good thing for JP Morgan because they're going to be able to write off a bunch of stuff. They're going to have some goodwill and some other things. Now, it might take a few months for this all to happen. Again, it's not going to happen in a day or even 6 months. This is going to take probably close to a year. It's a big bank, so it's going to take a year or two for this to walk through. So, hey, look, it's going to be interesting for me to listen to Jamie over the next several quarters as they gobble up First Republic and see how they handle it on a tax basis and how they handle it from a merger basis to see what kind of economies of scale they can actually make out of this, because they're getting a pretty good deal on it. And if they can actually turn it around to the point where they're actually be able to make that business even more profitable, it might just be a really big feather in Jamie's cap down the road. Again, net, probably a positive. Hate to see a bank go under. I hate to see people lose money on the stocks and the bonds. But for the majority of us, shouldn't affect us. If you have questions, comments, add them, please, as always. I'd be happy to answer as best as I can. Again, you always invest in your best interests so that you can retire when you want to retire and how you want to retire. Dickie out.